All right, welcome to the Explainer. Today, we're going to be decoding Bitcoin dominance, a single metric that really acts as a crucial weather vane for the entire crypto market.
So to really get this, you got to picture the crypto market as this constant battle for capital, right? You've got Bitcoin, the OG, the established king on one side, and then on the other, you've got literally thousands of these ambitious challengers, the altcoins, all of them just scrambling for a piece of that pie.
So how do we track this epic struggle? Well, analysts have this key metric, this number that tells us exactly where the money is flowing. And that right there brings us to the core of this whole explainer. What is Bitcoin dominance?
Okay, but before we jump into that, we need to get one basic concept down: market capitalization, or what everyone just calls market cap. It's super simple, really. It's just the total value of all the coins in circulation for any given crypto.
Okay, so once you've got that market cap idea in your head, Bitcoin dominance becomes incredibly easy to grasp. It's literally just the percentage of the entire crypto market cap that's held in Bitcoin. So going back to our pie analogy, it's just how big Bitcoin's slice of that pie is. And the math behind it? It's exactly what you'd think it is. You just take Bitcoin's market cap, divide that by the total market cap of all cryptocurrencies, and then multiply it by 100 to get that percentage. Pretty simple, right?
Well, here's where things get a little tricky. You might have noticed this yourself. If you go and check this number on different websites, you're probably going to see slightly different figures. And no, that's not a mistake. It all comes down to the fact that they're using different ways to calculate it.
So let's break down the two main reasons for that difference. First, it's what we call the coin universe. See, some websites track thousands and thousands of tokens, and that can really skew the data, especially with illiquid projects, like meme coins. But other places, like TradingView, they focus just on the top 125 to get a much cleaner signal. Then there's the stablecoin effect. This one's huge. When you include the absolutely massive market cap for stablecoins in the total calculation, it naturally dilutes Bitcoin's dominance. It just makes its market share look smaller than it might actually be.
Okay, so now that we know what it is, let's really dive in. Because this metric, it's way more than just a number. It's this incredibly powerful gauge of investor psychology. Seriously, understanding which way it's trending is just like reading a weather vane for the whole market's mood.
And here's the absolute key takeaway. When Bitcoin dominance is going up, that signals a risk-off mood in the market. It means investors are getting nervous and are flying to the relative safety of Bitcoin. But when it's going down, that's a risk-on signal. Capital is rotating out of Bitcoin and into altcoins because investors are feeling bold, they're chasing those higher, riskier returns. And that's often what kicks off what everyone calls altcoin season.
And you know what? We saw a perfect real-world example of this flight to safety not too long ago, back in 2024, when all that institutional money started pouring into those newly approved US spot Bitcoin ETFs. What happened? Bitcoin's market share absolutely surged, pulling a ton of capital away from the rest of the altcoin market.
But here's the thing. This simple tug of war we've been talking about between Bitcoin and the altcoins, it's getting a lot more complicated. Now it's being influenced by these massive game-changing forces from the outside.
Yeah, this isn't just a game for retail traders and crypto natives anymore. There are three huge forces that are fundamentally reshaping the entire digital asset landscape as we speak.
So what are these game changers? Well, first, you've got the absolute explosion of decentralized finance, or DeFi. Second, you have the big one, the arrival of Wall Street and all that institutional capital. And third, there's the ever-growing shadow of the global regulatory horizon. And this image here, it does a brilliant job of illustrating the challenge for big money trying to get into DeFi. See, for them, it's not just about buying some tokens. It demands a totally structured, layered approach to managing risk. Everything has to be built on this solid foundation of security and compliance before they can even think about the next step. And at the exact same time, you've got governments stepping in and becoming direct players in this space. On one hand, you have the G20 pushing hard for these unified reporting standards to get more transparency. But on the other hand, you have central banks all over the world developing their own digital currencies, CBDCs, which, let me tell you, could completely change the entire competitive landscape.
Okay, so with all this complexity, DeFi, Wall Street, regulators, how can you actually use this metric in a smart way without falling into the common traps?
Well, the analysis points to two simple but really powerful rules. Rule number one, look for the trend, not a specific number. The direction is what matters. Is it steadily going up or down on, say, a weekly chart? That's way more important than any single percentage.
And rule number 2, never ever use it alone. You've got to pair it with other indicators, like the total crypto market cap, for example, to really confirm the story that the data is telling you.
And this is so important. You have to remember its limitations. Bitcoin dominance is completely blind to the huge amount of economic activity that's happening on-chain in things like DeFi and NFTs. It also gets distorted by the thousands of new tokens popping up all the time. And maybe most importantly, it tells you absolutely nothing about how liquid other major cryptos actually are.
So all of this leaves us with a big final question to think about. As all this new technology and big money continues to reshape the crypto world, is Bitcoin's dominance going to be its defining feature forever, or is it destined to become just a historical footnote in a much, much bigger and more diverse digital world?